SD Bullion has just launched Survival Food, headlined by the only 100% organic, GMO-free survival food. Prepare like the doc. Purchase your survival food from SD Bullion today.
Metals and Markets is sponsored by DNA Precious Metals, a near-term producer of the Montauban tailings mine in Quebec, Canada. DNA Precious Metals trades on the OTC BB market under the symbol DNAP.
This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Well, Eric, gold and silver smash was continued this week with the release of the Fed minutes on Wednesday, and the Fed continuing their taper is coming right around the corner at the next FOMC meeting, MOPE. Gold was slammed on Wednesday through 1250 down to, I think, as low as 1240, might even touch 1239, and closed the week today on Friday almost at the week's low at 1272 and change in the afternoon access market. Silver was also slammed back under critical support at 20 and made a couple of attempts to get back above 20 later in the week on Thursday and Friday, but other than a couple of peaks or pops back above 20, has been unable to do that, and also closed at the week's lows, clinging to moderate support here at 1980, but really not too convincing of a bounce off of 1980, and looks like it could head lower the next couple of weeks to possibly retest that low near 18. So what's your thoughts, Eric, on where the metals go from here in the next couple of weeks and to close 2013 and early 2014?
Well, it looks like, we probably will retest those lows, and it's quite possible, actually. It could have a setup where the cartel will try to do that this coming week, because the Thanksgiving holiday period has traditionally been very active when it comes to cartel footsteps. You can see them throughout the years. I remember one time where they were absent, and at the same time China was active buying, and I can't remember the exact year off the top of my head. I should have looked this up before, but I believe it was 2006. And it was really surprising to see that, we had a really strong day when the rest of the United States and the comics market was out doing their thing, partying over the holidays. But the CME has lowered the margin requirements for gold and silver traders this week, and it's a rather odd timing that they do that. And generally they kind of couch that in terms of periods where, there's less volatility, lower volume, so forth, so we can better manage our risk profile, and therefore we feel comfortable to let people take on more margin. But that really doesn't speak to what's been going on in this week's trade. So it's a little fishy. It could, in fact, be an attempt to get people who are speculating on higher prices to get a little bit more margined in their accounts and be more vulnerable to flash crashes or running of the stops by the cartel, such that they'll get new, fresh margin calls, making people sell next week.
And there's a pretty significant decline in margin. I think it was 9.4% in gold contracts, reduced it from 8,800 down to 79.75 per contract, and silver was even a little more on a percentage basis, 11.1% from 12,375 per contract down to an even 11,000. So that's a significant reduction. We're talking 10%, give or take a percent, with gold and silver.
And it could cut either way, frankly. The sentiment is so terrible in this space that, in order to have speculators come out and get over-leveraged, they got to be interested in taking that trade, and there are not a lot of speculators out there, frankly, that want to go long right now. So it might just be a complete moot point. But it's worth pointing out because the setup is there, and traditionally the Thanksgiving period is one where the cartel does like to come out and bonk people over the head. And maybe we'll see that again this coming week. But, to further answer your question, the whole remainder period of the year is such that we have the political and MOPE incentive for the powers that be to keep things under wrap until Janet Yellen takes the reins of the Fed, comes in February 1st and makes her formal policy objectives known. She'll be doing press releases and supposedly being a little bit more open vis-a-vis how Bernanke had run things and whatnot, and there's not a lot of incentive for the powers that be to let things get out of control. So, we'll continue to see these really weird employment reports like we saw a couple weeks back where, the 126,000 jobs were created out of thin air for the birth-death model, and other economic reports being massaged and whatnot to get us through the Christmas holiday season where retail sales are all important for the U.S. economy. So that pretty much sets the backdrop for a continued interest to keep gold under wraps. And you can see that even in this week's trade. I mean, we've been relatively quiet and with not a huge amount of action Thursday and Friday, which to some extent is a positive because it just kind of shows that they're taking a breather from trying to manage prices lower, and at the same time, we haven't seen a huge amount of follow-through when it comes to hedge funds or other entities seeking to short sale the market because there isn't a heck of a lot of downside in their opinion, and you can see that expressed in terms of price versus volume, and that's technically it's a good thing because it kind of gives you some sense that the market will try to stabilize, but the overriding unknown in this scenario is whether or not the cartel wants to attempt to push prices lower, and they can in fact do that if they wish. So that's pretty much the tale of what we can see in prices in the last 3 days, and I'd encourage people to look at both the silver and gold charts for the last 3 days, like the 72-hour Kitco chart in particular can show you those trends pretty easily, and we'll put that up in the write-up for this week's show. So moving on.
If you can find any bullish stories or reasons to be bullish in the metals right now, it might just be the actions and as well as words of Goldman. They've just come out and made another publicly bearish call on gold, while at the same time, I think it was either Tuesday or Wednesday, the story came out from Venezuela that Venezuela has signed an agreement with Goldman to swap or exchange 1.45 million ounces of the country's international gold reserves that are currently being held at the Bank of England. So this is a portion or a small portion of their reserves that Chavez did not repatriate back in, I think, 2011 it was when he repatriated about 110 tons of Venezuela's gold.
And that mostly came out of the New York Fed.
Right, exactly. So this is not part of that gold. This is remainder or a small part of their reserves that were being held at the Bank of England. They've made a 7-year agreement beginning a month ago in October of 2013, running through October of 2020. And that of significance was the statement that the gold will be physically delivered to Goldman Sachs in exchange for U.S. dollars from Goldman. So, well, it kind of makes sense for Venezuela if you can look at it that way, which the socialist chaos that Venezuela is experiencing right now and their economy just totally going down the crapper with everything that's going on there if you've been paying attention to Venezuela at all. But at the same time, it's definitely a bullish note from Goldman that they're kind of throwing a unique playbook to acquire what physical they can outside of the normal exchange measures, like through the traditional exchanges like, say, the LBMA.
It did, in fact, call for a 7-year contract period where Venezuela would be getting payments through that whole 7-year period? Or
the agreement runs through October 2020 of 20. Mm-hmm.
Well, that's kind of interesting because that's the same period of time that was allocated for Germany's repatriation.
Exactly.
You got to wonder what that entails when it comes to possibly suggesting that, one, the gold may not even fully be there, because that's presumably what's going on with the case with the United States-based gold that Germany is attempting to repatriate, and over a 7-year period allowing the Federal Reserve and their bullion bank partners to slowly accumulate gold over the course of time from ongoing mine supply on an annual basis to actually repatriate for Germany. Maybe this kind of suggests that even in the LBMA inventories or in where else actually this would probably be stored in London under the UK's central bank leasing program. So that basically suggests that they're just trying to clean up the accounting of double and triple and God knows how often multiple sailed leased gold bars are, in fact, in that repository. And Venezuela's interest is simply just to get money or anything out of this, because they probably realized, just as Chavez had, that this whole Ponzi scheme will end, and there just aren't enough bars to go around for the multiple claims for each bar. So
either that, or they're just sending their gold to China in exchange for their free Samsung for every citizen.
yeah, well,
use it in the
the
circuit.
citizens would be mad because they'd have to wait for 7 years. Only 1 out of every 7 citizens would get a TV. It takes 7 years to get that out there. They'd have to do an agreement with Korea too, because Samsung's a Korean company, so who knows. But there's never a dull moment in these geopolitical machinations when it comes to the gold market, and this story is just one of many that continues to point to the fact that it's an open secret that there's not enough gold out there for all of the various claims against each bar in all of these repositories. I mean, any responsible political leader in a country is going to know this, and it's just a question of how they deal with the scenario, and in hopes of getting back their stored value in gold without rocking the boat and possibly having a military action against them, or who knows. Some of that has happened before in other countries. So anyway.
Well, speaking of geopolitical news stories affecting the markets, really couldn't have a session today without discussing the 50th anniversary of JFK assassination. I know you had wanted to address the latest from Paul Craig Roberts on the JFK assassination and just fraud in the current government, in the conspiracy in general. So,
Paul Craig Roberts is an interesting man in that he served in the belly of the government at the highest levels. Under the Reagan administration, he was the Undersecretary of the Treasury, which is the second highest ranking position in the Treasury Department. He used to be a co-editor in the Wall Street Journal, and is largely considered to be one of the founding fathers of supply-side economics, and basically in the 1980s was considered to be someone on the order of, say, Timothy Geithner that we would see today, somebody who really is representative of the policy establishment. And here he is now, completely on the outside, retired, and speaking out about things such as 9/11 truth and questioning people, asking why has Building 7 fallen in the same day, and very few in the media want to focus on that, and how did it fall in its own footprint and have very minimal fires? How does the JFK assassination stack up in terms of the implausibility of Lee Harvey Oswald being a lone shooter, and these very large subject questions that the mainstream simply would not like to have dialogue on are things that he's fearlessly showing on a day-to-day basis. Another example is that he was speaking about how the Osama bin Laden killing that Obama had claimed to have done was basically a propaganda job. And if you take the time to actually look at the body of evidence, it's very clear that that is indeed what happened. And, we don't have the time to get into all of these cases point by point by point, but bottom line is that he's probably the highest ranking former government official in the United States alive today, speaking truth to power when it comes to issues like this. And it's really important that our listening audience pay more attention to what he's writing, because while you may not agree with everything that he may say on any given issue or his frame of reference when it comes to politics and global macro analysis and what have you, but it's really important to recognize that he's one of the very, very few people in power and former power that actually are calling out government, speaking truth to power. So, I'll include a link to his latest article about the Kennedy assassination in the write-up for our show today, and I encourage people to take a look at it and read his writing. And also, there's one book in particular that he recommends that I would also recommend. I consider it to be one of the top 5, if not the very best book ever written on the Kennedy assassination. And you'll see that in the write-up of the show. So another thing, jumping back as well to the geopolitical realm that we really need to talk about is what's going on with China. And they announced a pretty strong statement this week. Basically, they're continuing this ongoing evolution that we've been talking about for the better part of a year now, of moving away from using the dollar as a world trade reserve status currency and settlement currency. And the central bank had issued a statement, and I'll quote, "It's no longer in China's favor to accumulate foreign exchange reserves." And during the third quarter in 2013, foreign exchange reserves in dollars, actually in total I should say, had risen to $3.66 trillion worth of reserves, and about a major portion of that is U.S. dollar based. I don't remember the exact number of those reserves constituted in dollars, but it's in the neighborhood of about 2/3. And what they're trying to do is basically continue developing all these bilateral trade relationships with countries to make currency denominated in yuan or rubles when they trade oil with Russia, or do swaps with euro when they trade with the European Union. And in fact, at this point, trade directly with the European Union and China exceeds the aggregate value of what they trade with the United States. And as the next year rolls forward, it's very likely that we'll see China continue pushing in this direction, and it's kind of it's contradictory in some people's minds when they kind of look at the question of, well, is China going to slow down in their growth and whatnot? But when you put that question in the context of what they're doing with their currency reserves and all of the strategic developments that they're trying to do with trade partners and whatnot, you can see an interesting pattern. And it basically unfolds along the following lines. Banks in China take all of the dollar payments that their exporters receive and give those exporters yuan that's freshly printed up in the Central Bank of China. And that has a pretty strong inflationary force within the domestic economy. And the way China deals with that is they try to raise reserve requirements within the banks such that the banks have to keep more of their freshly printed yuan that was given to them, or yuan that they'll take off of other channels when depositors put money into their banks. They'll put that into the balance sheet of the banks because they're required to, according to the regulations of the Bank of China, which slows down the velocity of money. And to help people understand how that works, you can see that dynamic, in fact, going on in the United States with our really low reserve or velocity of money in connection to all of this amazing amount of printing that's going on with the Fed, because basically the banks are keeping a huge amount of money on the balance sheet of the Fed and their accounts with the Fed, so it doesn't really show up in the economy right away. I mean, I'd argue that it will in time, and we've spoken about how that can in fact happen over time in other shows. But getting back to China, the really interesting thing there is that will give banks incentive to and permission by their authorities to lower reserve requirements and put more yuan into the Chinese economy, which will speed the economy up. Everyone right now is, or a great many people right now, are very fearful of China having a big slowdown, and a lot of people are even worried about a crash in China. And I think that the upside surprise in 2014 is that China will probably kick off a growth rate of in the neighborhood of 8.5%. Most people are thinking 6%, 7% right now. And the reason why that's going to happen as a surprise is that these currency changes that they're strategically massaging now, in fact, are going to have an unforeseen impact on their economy, because it'll allow their economy to grow faster and at the same time have less inflation, because the yuan will appreciate in price relative to the dollar, because they're no longer going to have to do all of these gymnastics to try to deal with all of these dollars. They're going to let the yuan rise relative to the dollar, and that's going to change the whole geopolitical discussion. People, are going to look at China and see that they're going to be a far more powerful country economically sooner rather than later, and that that will even further people's expectations more along the lines of, worldwide currency reset, changes in the evolution of the speed at which the dollar is no longer the reserve status currency universally, but maybe will become part of a basket, or who knows what strategy will ultimately be unveiled. But the bottom line is that China will have probably a lower problem with inflation, higher in growth economically, and their citizens will be empowered with a currency that will be higher in relative purchasing power, which will lower inflation as they import all of their natural resources and whatnot to power their economy. And those dynamics are unfolding kind of under the radar right now. And not many people on Wall Street are paying attention to this, and certainly when it comes to the policymakers in the U.S. government on a political front, most of them can't be, distracted from watching their porn or whatever. It's amazing to see all these dynamics unfold. But
it's not only porn anymore. Now they're actually physically having a relationship and sleeping around with the lawyers and the legal teams of the fraud that they're supposed to be prosecuting. So, I don't know if you saw that story this week or not.
Well, I missed that, but that's kind of that's old news. I mean, the new stuff is all of the great stuff they can do for high-speed bandwidth-enabled porn. I mean, they're really.
Right.
Yeah, everybody at Google should, and when they Google lobbies more in Washington, they should bring some more Google Glass wear for people in Washington to hook up on their computers.
The other interesting.
But now we're really going off into the ditch.
Right.
So
the other interesting point on China, kind of piggybacking on what Eric was saying, going towards next year in the future, was the story that China is going to start interbank gold swap trading effective Monday, November 25th. And again, that's on the heels of China's on pace to overtake India this year as the world's largest gold consumer, at least officially, as a lot of India's gold has gone underground into the black market. But that should further open up the China's precious metals market. So that'll be interesting to see as well.
It also adds liquidity to their banking system such that it even supports their effort to generically increase liquidity in their banking system with further growth of their bond market and the increasing size of their capital markets overall. I mean, that's one of the last vestiges of power that the United States has versus the rest of the world. And on the economic front, is just the sheer size of our capital markets make it super, super liquid. So when we have so much fiat-based monetary assets flowing around the world on any given day, I mean, the international trade in currency is bigger than anything under the sun. And part of the reason why the United States is still able to maintain a pretty strong economic front is just that the depth of our capital markets are able to absorb a lot of that. China knows that, and that's what that story is about. It's in the bigger picture, trying to make their capital markets broader. And then on another aspect, too, earlier this week, they announced that they're going to start trading yuan-based oil contracts on the Shanghai exchange. So, they're globalizing their capital markets in preparation for becoming a global economic power, and an order of magnitude much greater than where they've already been able to lift their nation. And this is all happening at a pretty fast rate, far faster than evolution had taken place in the United States in our economic development.
Right.
And I wouldn't be surprised to see that even by 2014, people who have not spoken a single word to date about the possibility of the dollar losing its currency reserve status and trade status will in fact be discussing it openly, and that this is going to start making people raise their eyebrows across the board, and it'll be a general subject in the mainstream media. And whether or not it actually happens in 2014 remains to be seen, but it's the issue itself is going to start raising its head a lot more clearly in the public debate.
Well, I wanted to give the listeners just a quick update on the retail silver market here in the U.S. before we wrap up today, Eric. We've kind of been looking over the last 2 or 3 weeks, especially at Silver Eagles, where the Mint has let all the primary dealers, the authorized participants, know that they'll be shutting down 2013 sales on December 9th. It'll be about 5 to 6 weeks before 2014 sales begin. And we've been looking for premiums to continue to rise, and we've continued to see that this week, and even delays have started to pop up. Premiums are up probably another 25 to 30 cents an ounce on the Silver Eagles, and we're starting to see delays again for the first time in a couple of months, 2 to 3 week delays across not all of the suppliers and the wholesalers yet, but several are now sold out and on delay, even their allocations that they're getting these last couple of weeks here before the sales stop on December 9th. So the premiums already continue to jump by about 25 to 50 cents a week over the last 2 to 3 weeks, and look for that to continue. And once those sales stop December 9th, so talking probably sometime mid-December throughout the next 4 weeks there, that's where we're really looking for premiums to start to move on some of the other alternative products like the silver maples, Philharmonics, generic rounds and bars, and those types of things. Supply remains really tight in the 90% silver. Premiums jumped up about 50 cents an ounce on that this week, and then really there's just hardly any supply at all. One or two even medium-sized investors could totally wipe out the entire wholesale market in the U.S. with a couple of phone calls. And really, Eric and I were kind of discussing off the air before the show started. If silver continues to stay below 20 and makes a move back towards 18, it won't be long at all before we're back in a retail shortage kind of crunch like we saw early in the year. We were discussing off air that really on Wednesday when silver broke through 20 and made it down to 1980, a lot of the big buyers that had been very active for those couple of months where silver was under 20 and trading around 18 and 19 that haven't really been making purchases as silver climbed back above 20 and made it through into the 25 and change, and it's kind of been slowly trading down since then. A lot of the big buyers came out and made some pretty substantial purchases, so we would expect that to continue if silver makes another challenge at 18, and if silver stays below 20 here for long, combined with the U.S. Mint 4 to 6 week shutdown, look for premiums to rise, probably especially in the Silver Eagles, but to spread to the other products, and delays and shortages to start to pop up really more broadly than just the initial signs we're seeing in the Silver Eagles right now. So something to keep an eye on. I think price of silver will play a role in that. So we'll see what the price does over the next couple of weeks here leading up to the Mint shutdown on December 9th. So we'll wrap things up there for this week. So once again, for the Doc and Eric Dubin, thanks for tuning in to the SD Weekly Metals and Markets.
SD Bullion.